So I have been investing £100 every single day into the S&P 500. It's been 7 days and I want to update you guys on a very crazy week. So as you can see, this is the fund that I chose, the iShares Core S&P 500, the GSPX. And the reason why I chose this is because this is a hedged version of the S&P 500, meaning that the currency fluctuation, pretty big fluctuation between the pound and the dollar that we're seeing right now, that won't play an effect so much in this series of video. But anyway, today you can see that it has been an appalling day, down by 1.35%. And I thought it was a great day to show you an update of the series. Now, I don't plan for this to be a weekly series. I will update you guys at the end of 30 days to show you what I've learned. But you can see over the past week, it has not been doing too well at all, down by 1.61%. Now, I also made a video a few weeks ago about how I spent £105,800 and it was into this same fund here. You can see currently I own 10,731 shares in the GSPX, and unfortunately today it has gone below my average buying price. So I am now down overall by 1.11% and a loss, a pretty huge one at that, unrealized of course, of £1,182. So as you can see, overall my stocks and shares ISA is looking really bad. Just the other day it was valued at £111,000. Today it's £107,000. That is a huge loss to be seeing in a portfolio. And the purpose of this type of video is just to show you in the short term, there will be a lot of volatility in the S&P 500. It is not suitable for a short-term substitute like a high yield savings account. That being said, Trading 212 is currently giving 4.9% as an annual equivalent rate on uninvested cash. Currently, I have £2,407. But please be aware that the majority of this cash is put into qualifying money market funds, which is classed as an investment, so your capital is at risk, unlike if you put that same cash into a Trading 212 cash ISA. If you would like to sign up to Trading 212 and receive a free fractional share worth up to £100, all you have to do is to click the link in the description box down below. Alternatively, if you've already signed up to Trading 212 in the past 10 days and haven't received a free share, all you have to do is click the 3 horizontal line menu over here, scroll all the way down until you see the use promo code section, and in this section, just enter my code JUBAIR. Now anyway, let's go into this pie here called £100 a day. As you can see, over the past week and 2 days, remember the stock market is only open 5 days a week. I started this at the beginning of the year on January the 2nd when the stock market opened. As you can see, on the first day, I deposited £100 and already there was a bit of a loss towards the end of the day. So the next day on Friday, I deposited another £100, still quite red towards the end of the day, down by 0.9%. So on Monday, things were looking a lot better. As you can see, at the end of Monday, my rate of return was 1.8% in the green, and that was a gain of £3.93. At the end of Tuesday, things changed. The rate of return 0.2%. And as you can see, Wednesday, again, rate of return -1%. And currently we are sitting after 7 days of depositing £100 every single day, down by 3.8%, or a loss of £13.67. As we can see, over the past month, the GSPX is down by 3.84%. However, when we compare this with the IUSA, that is actually still kind of up by 0.28%. And this is largely due to the weakening of the pound. So any return in dollars automatically gives us a boost because the pound is weakening, if that makes sense. But I prefer looking at it with a hedged ETF so we can see the actual movement that the S&P 500 overall is getting. This is a great example of why the S&P 500 is not a good short-term savings. It is not savings at all. It is not a good short-term investment. I get people commenting all the time, you know, they need money in 4 months. Is the S&P 500 a good thing? Because they see the 10% return average over a certain amount of years. But the thing is, you're not going to get that 10% average in the short term. Those are based on historical facts. And remember, past performance is no indication for future performance. You're not going to get, let's say, 10% divided by 5 months and assume you're going to get something around 4 to 5% just like that. As you can see, if I had lump summed £700 on the 2nd of January, we would still be down by quite a bit actually. We would be down about 1.8%, but because we have been investing every single day on this occasion, we would have been much better off doing the lump sum. Again, like my previous videos have shown, usually lump summing does seem to be beating out dollar cost averaging. But then again, it is not normal for someone to be dollar cost averaging every single day. The other thing that I wanted to update you guys on was my other pie that I had from last year, the S&P 500 every day. So here, as you can see from my net deposits, I actually invested £10 a day for about 60 days. One of those was £20 in one day due to auto invest. But as you can see, since the 15th of October, I've been investing £10 a day. That has been over a longer period of time. And that investment currently stands at a rate of return of 4.9%. or a gain of £15.15, which means I got in return about 1.5 days worth of deposits. Now, of course, the main difference between this experiment and the previous one was that the fund that I chose was the IUSA, which was not a hedged version. And currently we aren't seeing the big losses the Americans are seeing because our pound is weakening and the dollar gives more of a return to the pound just because the pound has weakened. So make sure to check out some of my other videos and I will see you in the next video.